Welcome to Explain the Charts, where we break down the most important price action in the market. Today is Monday, March 23rd, 2026, and we are witnessing a massive shift in sentiment for the Nasdaq 100. Geopolitical tensions reached a boiling point over the weekend as the U.S. issued a 48-hour ultimatum regarding the Strait of Hormuz. However, President Trump just announced on Truth Social that he has postponed military strikes on Iranian energy infrastructure for 5 days. He cited very good and productive talks, which has provided a temporary reprieve for a market in freefall. Oil prices, which had spiked past $100, have retreated significantly following this news. WTI crude fell roughly 7% to $91, easing some of the immediate inflation fears. Despite this, we are still dealing with a very hawkish Federal Reserve and sticky inflation data. No rate cuts are currently expected before 2027, and the market is still pricing in stagflation risks. On top of the macro fears, the tech sector was rocked by the arrest of the supermicrocomputer co-founder on Friday. The charges involve NVIDIA GPU smuggling to China, which caused SMCI to plunge over 33%. This combination of war jitters and corporate fraud led to a brutal close for QQQ last week. Looking at the daily chart, the technical damage is clear as we see the fourth straight week of declines. QQQ hit a long-term peak near $637 in late October before this downward spiral. We can see a consistent series of lower highs and lower lows over the past 2 months. The recent rejection from the $613 level in early January confirmed the bearish momentum. On Friday, March 20th, the index closed at $582.06. This level is significant because it puts the Nasdaq nearly 10% off its recent highs. We are officially testing the boundaries of a market correction. Support at the $580 mark is the most critical level for bulls to defend right now. If we break 580, the technical floor becomes very thin, potentially leading to a move toward 570. The daily volume on Friday was exceptionally high, signaling that many participants were dumping shares into the close. However, the news today about the strike postponement could act as a catalyst for a relief bounce. Resistance is stacked up heavily between $600 and $605. Notice how the candles have struggled to maintain any ground above the 200-day moving average recently. Let's move to the 1-hour chart to see how buyers attempted a repair earlier this month. Between March 2nd and March 9th, we saw a brief period of bullish optimism. The price managed to bounce from $591 back up to $610. This recovery looked real for a moment, but it ultimately failed to break the structural downtrend. The hourly candles show that every attempt to rally was met with high-volume selling at the overhead resistance. This suggests that the sell-the-rip mentality is still very much in play among institutional traders. The point of control during this period shifted higher, but it wasn't enough to turn the tide. By March 10th, the news of the escalating conflict in the Middle East began to weigh down the price again. This hourly data highlights that the market is hypersensitive to energy prices and geopolitical headlines. Even when order flow improves, a single headline can wipe out days of progress in this environment. Now, let's zoom in on the 15-minute chart to see the carnage from this past Friday. On March 20th, the selling pressure was relentless from the opening bell. We can see the price hovering around $591 during the mid-morning session. However, as reports surfaced that the administration was considering blockading Kharg Island, the floor dropped. The selling intensified in the final hour of trading, which is usually a very bearish signal. We crashed from $589 down to the $582 close in a matter of minutes. The 15-minute candles show consistent red volume bars with very little dip buying activity. This intensifying sell-off suggests that traders were terrified of holding positions over the weekend. With the VIX fear gauge crossing 30, the volatility was simply too much for many retail investors to handle. The gap between the VWAP and the closing price shows how far the bears pushed the index by the end of the day. As we head into this week, we have reasons to be both cautious and selectively bullish. The bullish case depends entirely on the diplomatic success of the next 5 days. If the strike is cancelled and the Strait of Hormuz reopens, we could see a massive short squeeze. In that scenario, QQQ could easily reclaim the $600 level by the end of the week. On the bearish side, structural inflation and high energy costs are not going away. Goldman Sachs predicting $85 Brent crude for 2026 suggests that the geopolitical risk premium is here to stay. If talks fail, we are likely looking at a drop to $570 or even $560. The semiconductor sector, led by the SMH ETF, remains a major vulnerability for the Nasdaq. Watch for any further federal charges related to SMCI, as that could cause more contagion in tech. Short term, we are looking for a bounce to test resistance, but long term, the trend remains bearish. Traders should be looking for a daily close above 605 to confirm any real reversal. To recap our analysis, the key price levels are support at 580 and resistance at 603. I estimate a 60% probability of a relief rally this week given the 5-day strike postponement. This prediction is reinforced if oil stays below $100 and if the VIX starts to contract. However, there is a 40% chance of a breakdown if the diplomatic talks with Iran show no progress. Keep an eye on the Chicago Fed National Activity Index and the metals royalty IPO for additional market context. Watch for the 50-day moving average crossing under the 100-day as that ominous signal is nearing. Always manage your risk and stay disciplined in this high volatility environment. This video is for educational purposes only and does not constitute financial advice. Please conduct your own thorough research before making any investment decisions. Thank you for watching Explain the Charts, and we will see you in the next analysis.